That clicking sound your seatbelt makes. It's a familiar sound, right? You buckle your seatbelt every time before you drive. Or maybe sometimes you've said to somebody else or somebody said to you, the car's not going to move until you buckle your seatbelt. However, most of the times, it's just part of your habit. You see, there's so many examples in our daily lives where we plan to avoid risk. Buckling our seatbelts before we drive, putting on safety goggles before we do a home renovation project, pilots and flight attendants doing a checklist before a flight. In each of these cases, they're no longer thinking about the risk, they're planning to avoid the risk. The planning is what becomes part of their natural habit. Now yes, accidents still happen, but by planning to potentially avoid the risk, in each of these cases, we've greatly reduced our exposure. So what about your retirement? Are you just thinking about the risk? Or are you planning to potentially avoid the risk? Today we're going to talk about 5 of the most common risks to your retirement and how you can plan to potentially avoid those risks. I'm Scott with Sierens Financial Group in the Retirement 360 Blueprint process, where we help retirees and pre-retirees answer their key questions. Are you on track for retirement? What can you do to improve your financial picture? And how can we potentially reduce your tax picture? Subscribe to our channel so that way you get notified as we're going to continue to come out with other informational videos to help you in your retirement plan. Just like driving a car, getting on a plane, or doing a home renovation project, your retirement is surrounded by risk. Today we're going to talk about the risk around your retirement and how you can plan and the actions that you can take to potentially avoid them. The first risk we're going to talk about is market risk. Now this is the primary risk that most people think of, the ups and the downs of the market. Before we talk about how this is a risk, I think it's first important to understand the difference between our working years and our retirement years. In our working years, we're potentially working for a company and collecting a company paycheck. Well, we're collecting the paycheck and we're contributing to our retirement accounts. But in our retirement years, this completely changes. You see, we no longer have that company paycheck. Instead, we just have what I like to call as our bucket of money. Now, when I say bucket of money, think about everything you've saved up, your retirement accounts, IRAs, 401ks, 403bs, your brokerage accounts, your checking, savings, CDs. You see, in our retirement years, this bucket of money, well, that becomes your new company. And you have to do what I call, to live your lifestyle, is cut your own personal paycheck. Basically, that's taking withdrawals from your bucket of money. So how does this become a risk? Well, if the market is down, the level in your bucket is down, but you still need to live your life, right? So you still might be taking out those personal paychecks. By making withdrawals while the level of your bucket is down means that it's going to take even more returns to get the level of your bucket back up. You see, most advisors are just going to ask you if you're conservative or moderate or aggressive. Well, frankly, those words mean something different to everyone. What I'm here to tell you is that you need to utilize your income plan to determine how much you're going to have in upcoming withdrawals. Then utilize those figures to determine how much you should have in your war chest and then how much you should have on the growth side of your portfolio. So regarding market risk, here are some key actions and habits that you want to put in place. First off is that you want to develop a rainy day fund. This would be your checking, your savings, your money market accounts, safer locations to put your money, so that way you've got a location to go to and grab money in the event that the market is down. Next is utilizing your income plan. Determine what your upcoming withdrawals will be to find the right balance between how much you should have in safer assets and how much you should have in growth assets. Now, if we get too much on the growth side, that could be a potential risk when the market goes down. But if you get too conservative and you have too much in the safer assets, well, that's where risk 2 and risk 3 come into place, which are inflation and lifespan. What's most important is the habit that you build around these items. This is what we do for our clients on an ongoing basis, but you want to continuously review these actions and rebalance your overall portfolio as needed. Another risk to retirement is inflation risk. Not only do we need our money to last, but we need our money to grow to keep up with the cost of goods going up. For example, the postage stamp in 1990 cost 25 cents. 30 years later, in 2020, the postage stamp cost 55 cents. It is more than doubled. Take a look at a loaf of bread. In 1990, it was around $1. 30 years later, you're looking at $2 to $3. Again, it is doubled or more than doubled. So think about some of the activities that you want to do in retirement. Dining out, traveling. Over a 30-year retirement, are you prepared in the event that the cost of goods or the activities that you want to do double in cost? 3% is a commonly quoted average rate of inflation. Is that something that you've taken into account in your plan? When it comes to planning actions that you should take to potentially avoid the risk of inflation to your retirement, well, you need to have a growth plan in place. That means money that's allocated to growth asset classes and allocated for use 10, 20, and 30 years from now. The next risk to your retirement that we're going to discuss is lifespan. I know what you might be thinking. Most people say longevity risk, and while yes, the number one fear of retirees is running out of money, living longer than your money lasts, what I'm here to tell you is that there are risks with both longer life expectancy, but also risk with unexpected premature death. Why do I bring up unexpected premature death? Well, this is a risk that some couples may face, an unfortunate circumstance where one spouse passes away early on in retirement or early on in life, and therefore the remaining spouse, their income is cut. Their income sometimes could be cut in half and sometimes more. If you're both collecting Social Security, you only get to keep one of the two Social Securities. If the spouse that passed away was collecting a pension, are you fully aware of what the spousal benefits are on that pension? So for couples, are you fully aware of what your income would be if one spouse were to pass away? The lifespan risk that most people are familiar with is longevity risk, making your money last as long as you will. People are living longer, and with advancements in technology in healthcare, life expectancy is going to continue to rise. Celebrating a 100th birthday is no longer out of the norm. So do you understand how much you can take out of your accounts and make your accounts last? The actions that you want to take in regards to this type of risk is having an income plan in place. Structuring out all of your sources of income like Social Security optimization, pension planning, spousal benefit planning, and withdrawals from different accounts and which account you withdraw from first, second, third, etc. Testing all of these sources, when you're going to turn them on and how long that they'll potentially last. And this will help you determine how much of a personal paycheck you can cut from your accounts. Even more important is have rules and contingencies in place in the event that one spouse were to pass, or that there's a market correction, or in the event of a bear market. The next potential risk to your retirement are health-related risks. This could be an unfortunate diagnosis or the need for long-term care support. As part of the natural aging and maturing process, we might need help from others to complete activities of daily living. Health-related risk can cost hundreds of thousands of dollars. When it comes to actions that you can take regarding health-related risk, one is, do you have the ability to self-insure? Or two, you can transfer all or part of the risk to an insurance company. Another common risk to retirement is tax rate risk. I want you to ask yourself, is a majority of your money sitting in IRAs, 401ks, 403bs, 457s, or other types of retirement accounts? If so, like many others, your money sits in a bucket that has not yet been taxed. And yes, the IRS at some point in time is going to want their cut. So you have to ask yourself, do you feel in the future taxes are going to stay the same, go down, or go up? Now, if the government decides to raise taxes to pay for the trillions of dollars of debt, how is that going to impact your plan? Will your money still last, or are you going to have to make reductions to your lifestyle? Also, another thing to think about if you're a couple is if one spouse were to pass away, most likely the remaining spouse would be taxed at a higher rate. Meaning, at one income versus two, they're going to have to withdraw more money to keep a similar lifestyle, getting taxed at potentially a higher rate, which would tell us then that they're going to reduce the bucket at an even faster rate. Here are some planning actions that you should take regarding tax rate risk. One is understanding which tax buckets your money sits in today. Is it in the taxable bucket, meaning that it gets taxed each and every year? Is it in the tax deferred bucket, meaning that it's going to get taxed at some unknown rate in the future? Or is it sitting in the bucket that grows and withdrawals are taken tax-free? For those of you that are still working, it's important to take a look at your overall plan and make sure that you're contributing to the right tax bucket. Last, it's important to take a look at your overall picture and see if there are benefits in potentially shifting money from the tax deferred bucket over and into the tax-free bucket. Just like buckling your seatbelt before your next drive or putting on safety equipment before tackling your next home improvement project, what planning actions will you put into place to potentially avoid the risk in your retirement journey? If you have questions regarding your retirement plan and actions that you should be taking to potentially avoid risk in retirement, utilize our website to set up a 20-minute complimentary call. Also, if you found this video to be of value, subscribe to our channel so that way you get notified as we continue to come out with other informational videos to help you in your retirement plan.